The camera cuts to flashing red screens. 30-year Treasury yields surged to 4.82% after a $25 billion auction collapses under the weakest demand in nearly 2 years. Reuters calls the bid to cover ratio ominous, the lowest since late 2023. For Washington, it means the government just paid more to borrow. For investors, it signals a deeper unease. Confidence in what's supposed to be the safest market in the world is no longer guaranteed. 10-year yields jump alongside, touching 4.24%, dragging mortgage rates higher and reshaping every loan tied to the benchmark. Bloomberg notes yields have remained above 4% for 3 consecutive years, a stretch not seen since before the 2008 financial crisis. Scott Bessent, overseeing Treasury operations, isn't raising funds for new programs. He's simply refinancing past obligations. Every auction is just another spin of the debt treadmill, and that treadmill is picking up speed. Initial jobless claims tick up by 7,000 to 226,000, normally a sign that would pull yields lower. Instead, they rise. Productivity jumps 2.4% in the second quarter, another figure that should ease inflation concerns. But again, yields ignore it. MarketWatch warns the bond market, maybe signaling something troubling. Fed rate cuts aren't working. Data that used to calm markets now barely registers. Then comes a policy shock. U.S. Customs issues new guidance. 1 kilogram and 100-ounce gold bars will now face a 39% import duty. Switzerland, America's top supplier and global refining hub, accounting for nearly a third of U.S. gold demand, is suddenly in the crosshairs. Reuters reports Switzerland exported 7.8 billion Swiss francs worth of gold to the U.S. last year. That trade route is now in jeopardy. The safe haven asset investors rely on when treasuries wobble just got more expensive. Markets lurch. December gold futures spike to $3,534 an ounce, an all-time high. The spread between futures and spot prices stretches more than $120, the widest in years. Traders call it a stress fracture. When paper gold prices decouple from the physical market, it signals a loss of faith in benchmarks. The Swiss Precious Metals Association warns a tariff will severely disrupt global bullion flows. A bedrock of the financial system is starting to look unstable. Meanwhile, pressure mounts on U.S. consumers. An APOR poll shows 53% of households cite grocery prices as a major source of financial stress. Inflation has cooled since its 2022 peak of 9.4%, but staples like beef, coffee, and orange juice are still climbing. One reason? Tariffs. Michigan state economist David Ortega explains that grocery bills shape how people feel about the entire economy. At the checkout line, trade policy isn't theoretical, it's personal. The Treasury reaches again. It announces a record $100 billion sale of 4-week Treasury bills. MarketWatch calls it the largest short-term borrowing move in U.S. history. But 4 weeks only buys time that runs out fast. Every month, that entire stack must be rolled over at whatever rate markets demand. It's a patch, not a fix, one that stabilizes the present while compounding future risk. Europe offers little relief. The European Central Bank has cut rates 8 times. Still, long-term yields in Germany, France, and the UK continue to climb. Barron's notes the central bank toolkit is looking blunt. If Europe can't push yields down, why expect the Fed to succeed? There's growing evidence that long-dated bond markets have decoupled from monetary policy itself. The White House defends tariffs as a strategic tool. President Trump cites Alexander Hamilton's use of duties to raise revenue and protect industry. But the modern application goes far beyond revenue. Tariffs on India for Russian oil purchases, on Europe for subsidized steel, on agriculture, each framed as leverage in broader foreign policy disputes. But retaliation comes swiftly. Partners buy less when the U.S. exports fall. Tariffs meant to project strength end up undercutting demand for American goods. Markets react immediately. After gold hits a record, the president posts on social media, "Gold will not be tariffed." Futures tumble 2.4% to $3,474. Spot prices fall 1.2% to $3,357. The Guardian calls a sigh of relief, but the damage is already done. The mere threat reshaped hedging strategies, widened spreads, and rattled confidence in U.S. policy stability. A promise reversed is not the same as a promise never made. Globally, investors scan for safer footing. In India, a 10-year bond auction collapses. Yields spike 24 basis points after banks and insurers refuse to buy. In Japan, a 40-year bond sale draws the weakest demand in years. Reuters links both to growing concerns over fiscal sustainability. This isn't just an American issue. Around the world, sovereign borrowers are being forced to offer more to attract buyers. The common thread isn't growth. It's credibility. Back in Washington, Besant watches the cycle tighten. More borrowing drives yields up. Higher yields increase interest costs. Bigger interest costs require more borrowing. Bloomberg estimates U.S. interest payments will exceed $1 trillion this year. More than defense, more than Medicare. This isn't a forecast. It's already printed in Treasury ledgers. Cutting spending is politically radioactive, but without it, the debt treadmill only runs faster. Raising taxes is just as politically toxic. Investors are already signaling disbelief in the government strategy. Tariffs pass their costs directly to households. Even gold, long a symbol of stability, has turned volatile under sudden policy shocks. Every tool that once worked now seems to produce the opposite effect. American consumers are adjusting. Surveys show families eating more meals at home, buying smaller packages, and relying on coupons. Kroger reports declining sales as shoppers turn to cheaper private label brands. Mondelez, the maker of Oreos and Chips Ahoy, posts a 3.5% drop in North American revenue. Interim CEO Ron Signorelli admits a tariff war aimed at foreign rivals is hitting American grocery carts instead. Foreign actors see opportunity. As U.S. demand for imported gold stalls, Chinese refiners and exchanges step in. When Americans hesitate, China accumulates. The shift is not theoretical. It appears in customs data. What the U.S. rejects, others absorb. And still, the Treasury presses forward. Another $100 billion in bills. Another auction greeted with tepid demand. Another rise in yields. The system that once ran on predictable signals now seems inverted. Weak job data used to lower yields. Now it doesn't. Strong productivity once reassured markets. Now it's ignored. Rate cuts abroad used to pull yields down. Now they have no effect. The feedback loop is broken. So the question becomes, if the world's safest asset no longer responds to the forces that once defined its safety, what exactly keeps it safe? Bond buyers are demanding more. Gold buyers are being taxed. Grocery shoppers are squeezed. Short-term debt piles up like kindling. And the national debt now produces an interest bill larger than the entire U.S. military budget. Every attempt to pull a lever, rate cuts, tariffs, subsidies, tightens a knot instead of loosening it. Interest expenses pass $1 trillion, more than defense, more than Medicare. It's not a projection. It's a line item already in the books. And it's growing faster than Washington can manage. This is where panic begins. Not in collapse, but in the quiet realization that the levers of control no longer function as expected. So what happens when every traditional tool of power, debt, tariffs, currency, even gold, stops working as designed? If every lever now works in reverse, what holds the system together? Behind the flashing bond screens, another unsettling number surfaces. Fitch Ratings, which downgraded U.S. debt last year, issues another warning. If debt ceiling brinkmanship continues and auctions falter, further downgrades could follow. Moody's, the last major agency still giving the U.S. a pristine AAA rating, has already put the country on negative outlook. A downgrade would trigger forced selling from pension funds and insurance firms bound by rating rules. The scale is staggering. Over $7 trillion in assets could be directly affected. Meanwhile, unexpected winners emerge from the chaos. Dubai's gold exchange reports a surge in U.S. investor activity. Purchases are rerouted through offshore accounts, bypassing U.S. tariffs and exploiting global trade routes Washington can't fully police. Singaporean refiners confirm rising orders, much of it traced back to American brokers. Policies designed to restrict imports are accelerating the offshoring of wealth. Back at home, another pressure point appears. Consumer credit data shows strain intensifying. The Federal Reserve reports average credit card interest rates at 21.6%, the highest since tracking began. With 10-year Treasury yields elevated, banks are pricing loans higher. Many households now face borrowing costs above 25% on rolling balances. Every bump in Treasury yields ripples straight into family finances. Even Wall Street is showing cracks. Bloomberg reports foreign central banks reduced their Treasury holdings by $42 billion last quarter, the sharpest drop since 2016. China and Japan, the two largest holders, cut exposure while increasing gold reserves. The IMF notes that global official gold purchases remain at record highs. What Washington frames as a temporary tariff battle, rivals see as a warning. Reliance on the dollar comes with risk. That's the heart of the spiral. Every move meant to project strength pushes capital outward. Every attempt to assert control chips away at credibility. And the world is watching, quietly recalibrating, quietly shifting its wealth.